Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger, and in today's video, we're going to be talking about whether Altria's nearly 10% dividend yield seems too good to be true, and I'll share what I'm thinking about doing with my shares, which I've owned since 2015. As you can see, the cigarette manufacturer's dividend yield has steadily risen over the past year from its historical norm near 8%. With a yield this high, you'd make your money back in around 10 years from dividends alone, regardless of where Altria's share price goes. That sounds pretty good for retirement portfolios that want to maximize passive income and be able to ignore the ups and downs of stock prices, but it makes a big assumption that Altria's dividend can actually remain safe over that period. Before taking a deep dive into Altria's outlook and dividend safety, I want to take a couple minutes to explain the cigarette industry's history. I think this is important to understand since Altria has some tough decisions to make about where nicotine demand could be headed in the years to come. Now, putting ethical concerns aside, tobacco stocks are popular holdings in many retirement portfolios because they have been predictable, cash-rich businesses for a very long time. According to a magazine published in 1985 by the Philip Morris Company, American Indians are credited with inventing the cigarette, having wrapped tobacco scraps in straw, reeds, and even corn husks. Native Americans gifted Christopher Columbus dried tobacco leaves after he reached the Americas during his 1492 voyage. Columbus initially threw the leaves overboard since they smelled bad and couldn't be eaten. But as he made his way around the Caribbean, his crew observed people smoking for the first time in Cuba. The light bulb went off, and they brought some tobacco leaves home to Europe. And for the next 250 years or so, pipes and cigars were the only means of enjoying tobacco in most parts of Europe. Cigarettes were virtually unknown and were fashioned mostly by beggars who would collect cigar butts and unburnt tobacco that the wealthy had tossed aside. It wasn't until the Crimean War of 1854 that the social awareness and acceptance of cigarettes would begin to rise. Soldiers from France and Britain were exposed to hand-rolled Turkish cigarettes, which gave off rich aromas and filled tents with smoke. After the war, veterans brought their tastes for these cigarettes back home with them, and around the same time, a young man by the name of Philip Morris had opened a tobacco shop in England and was selling cigars and pipe tobacco. One day, Morris saw a war veteran puffing on a cigarette and decided to add custom-rolled cigarettes to his product line as he sensed a new trend could be emerging. And boy, was he ever right. At the start of the 20th century, cigarettes made up just 2% of tobacco product sales, but by the mid-1900s, following two world wars, they accounted for over 80% of the industry, according to a 2006 article published on the National Library of Medicine's website. During this time, Altria's Marlboro brand grew to become the world's best-selling cigarette by 1972. Cigarettes still account for roughly 85% of Altria's revenue today, with cigars and chewing tobacco making up almost all the remainder. But there are growing signs that the tobacco industry could be on the verge of another long-term shift, one that might not treat Altria so well this time. Smoking rates in the US have declined for decades, but the addictive nature of nicotine and the brand loyalty behind Marlboro have enabled Altria to more than offset these lower volumes with higher prices. You can see that Altria's revenue has edged higher over the past decade, even though the company sold about 40% fewer cigarettes last year compared to 2014. However, if you've followed any of the big tobacco companies for long, you've probably heard references to vaping, heated tobacco, and other so-called reduced-risk products that are providing more options for smokers to switch to less harmful nicotine delivery methods. Adoption of these smoke-free products was slow at first, but they're beginning to gain traction from traditional cigarette smokers. Altria recently had an investor slide out that showed the cigarette share of nicotine volume in the US has fallen from 80% in 2018 to 60% in 2023, with e-vapor racking up most of the gains and driving overall nicotine consumption slightly higher. Now, it's hard to point out any one factor behind this shift. Maybe inflation has contributed as the cost of cigarettes grows ever higher and inspires more smokers to cut back, or maybe interest in newer products like vaping has simply increased. It's hard to say, but either way, Altria's cigarette sales volumes have declined at a faster pace the last 2 years. This chart we made plots Altria's cigarette volumes in blue and their year-over-year change in orange. You can see that low to mid-single-digit declines were common since 2007, and the back-to-back 10% declines in 2022 and 2023 really stand out. It's also incredible to see that Altria shipped about 100 billion fewer cigarettes last year compared to 2007. Now, some investors look at this chart and they worry that Altria's ability to offset future volume declines with higher prices could be reaching a tipping point. This would be concerning since Altria is far from a leader in nicotine markets of the future like vaping and heated tobacco. And the most important and largest smoke-free category of e-vapor, which grew 35% last year in the US, Altria made a $12.8 billion investment in e-cigarette maker Juul in late 2018. This deal ended up being a total flop as Juul shortly later faced lawsuits and pressure from regulators who worried about its role in causing a teenage vaping epidemic. Altria took almost a complete loss on this bet and pivoted last year to an FDA-approved vaping company called Enjoy, which it bought for $2.75 billion. However, Enjoy only has 3% share in the US vaping market. In heated tobacco, Altria sold its exclusive right to sell IQOS products developed by Philip Morris International and instead formed a joint venture with Japan Tobacco in 2022. While heated tobacco adoption is far behind e-vapor in the US, it's hard to imagine Altria having a strong position in this market compared to the heated tobacco sticks developed by Philip Morris International, which has invested billions of dollars in R&D to make these products and is already selling them almost everywhere worldwide. Last but not least, in oral tobacco, Altria's nicotine pouch called On has 6% market share, but this smoke-free category will likely remain much smaller than e-vapor and heated tobacco. Overall, just 1% of the company's sales are derived from reduced-risk products, and its relevant brands have less than 10% share in their respective smoke-free categories. In many ways, I think Altria faces the classic innovator's dilemma. Management's 2028 goals seek to maintain the company's 60% operating margin, but recognize the need to invest more in vapor and heated tobacco, the very products that risk cannibalizing demand for high-margin cigarettes. Altria hopes to generate $2 billion in revenue from innovative smoke-free products by 2028, up from $165 million in 2023, but we estimate this category would still represent only around 10% of total sales. That might not be enough for management to feel confident in Altria's long-term future, depending on how the nicotine market has shifted by then. Cigarette volumes could continue declining at a faster pace going forward, especially if U.S. regulators make progress on a proposal announced in 2017 to create a rule limiting the amount of nicotine in cigarettes. As of early 2024, the FDA said that work toward proposing a rule that would establish a maximum nicotine level in cigarettes remained a top priority. The goal would be to make these cash cow products less addictive, reducing the pool of future smokers while potentially breaking the inelastic demand profile of cigarettes that has given Altria pricing power for decades. If this scenario plays out and Altria still lacks leading products in the most promising categories of e-vapor and heated tobacco, the company could be forced to make another large acquisition to try and catch up. Altria's BBB investment-grade credit rating and low leverage support some acquisitive growth, but as we saw with Juul, investments in these emerging industries are risky as regulations and consumer preferences can shift over time, and the leading brands will carry hefty price tags. So, what does this all mean for Altria's dividend? In the near term, I think the dividend looks safe. You can see that Altria's payout ratio sits near 80%, which is pretty consistent with its historical levels. While that might sound high, the tobacco business is capital light and enjoys recession-resistant cash flow, allowing companies like Altria to safely maintain higher payout ratios than other industries. From a debt perspective, Altria looks pretty good there too. You can see the company has made nice progress returning its leverage ratio to a more comfortable level after debt spiked in 2018 to buy Juul. So for now, I think management can make good on their goal to deliver mid-single-digit dividend growth through 2028, but Altria ultimately needs to start demonstrating progress soon with its smoke-free products to inspire more confidence in the firm's long-term outlook, especially if legislation capping nicotine levels in cigarettes moves forward. If the transition away from combustible cigarettes picks up faster than Altria anticipates, the company's 80% payout ratio could rise higher, and it may no longer be sustainable if higher investments in alternative products prove to be necessary. Overall, we give Altria a borderline safe dividend safety score, which balances the company's stable footing in the near term with a fuzzier long-term outlook. I've owned shares of Altria in one of our 3 model dividend portfolios that are in our newsletter since 2015. The stock's subdued valuation and defensive qualities have kept me holding for now, but this is a position I'd like to eventually move on from. At the end of the day, I just think that Altria's path to long-term profitable growth becomes blurrier with each year, and I'm not a fan of large acquisitions which could be required in the years ahead for the company to adapt its portfolio at a faster pace. Now, I think it could do a lot worse for a 9% plus yield, but it's not something I'd feel great about owning 5 to 10 years from now as the industry shifts. I hope my analysis of Altria has been helpful for you. If you enjoyed this video, it'd be a really big help for us if you could click the like button below and consider subscribing to our channel for more objective analysis on dividend investing. There's no obligation, but if you're into dividend stocks and looking for ways to generate safer income with less risk, you might also want to try our website, Simply Safe Dividends. You can track your entire income portfolio to stay on top of your dividend safety, diversification, undervalued holdings, and a lot more. We also offer a screener, a newsletter, regular research that makes it really easy to stay on top of your income investments. Our site is free to try and it only takes a minute to sign up to. You can use the link in the video's description below. Thanks again for watching, and I hope to catch you next time.